Hello everyone and welcome back to Magno Investments. Today, as you can see, we are on the website, on the Substack. I will let the link in the description as usual in order to subscribe if you are already not. And today we are going to analyze an interesting business we have here, and it's called Viafin service. What is Viafin? Viafin is a small business, as I put here. It's not a tech company nor a trend stock. Okay, this is the kind of small, quiet, and boring businesses I like to understand and research. And it is involved in the maintenance industrial service. Okay, I will be very brief, as I like to do this kind of videos because I like to point some areas, some specific parts of the thesis I consider that could be a little bit difficult, so you can understand them better. Regarding the core business and geographic presence, the overall picture is that they operate in the industrial service maintenance, the process piping, and also the gas and energy infrastructure. Okay, as commented, they only operate in Finland, exclusively in Finland. They do not operate abroad in other countries. And through their network of 32 local units spread across the 23 locations in the country, they serve the blue chip industrial clients, in this case, pulp, both metals, energy, and chemicals. The business model structure, okay, is quite simple and profitable, because the core business, okay, is the maintenance service, and they also have a part of project execution. The first one, the maintenance, is approximately the 75-80% of the revenues of the company, and it is quite recurrent. Okay, and this is so important for all the theses, because I have seen a lot of companies which claim that their revenues were also so recurrent and they were so stable, but when the economy had a struggle, when the economy went wrong and went bad, these revenues of these companies just disappear. Okay, this vanish. So this does not happen with this company. They have a really good stable revenues, and the other part of the projects weights around the rest 25-30% of the revenues. And this part is quite small in relation of the overall picture, and also the projects they are involved are not much bigger than 1 up to 5 million euros. So again, the part of the revenues which are more exposed to the market, to the economy, to cyclical events, are, let's say, quite covered, because it only represents 25% of the revenues, and also the projects they are involved represents only 1, 2, 3, 5 millions of euros. The importance of the maintenance demand. Viafin, what it has and what it entails is a win-to-win relationship, and I explain myself. If the economy again goes well, okay, the recurrent revenues comes, and also the project revenues. Why? Because the companies will have to develop and build new facilities, and Viafin will do it to their clients. And also, if the economy is going bad, the clients do not have much money, it doesn't matter, because the services that Viafin offers are quite critical. Okay, there is an inverse correlation, because if you are operating the chemical industry and you have a lot of equipment, a lot of machines, you need to upgrade them, you need to repair them. So this is a non-discretionary service. You cannot avoid to pay someone to repair your machines. I mean, imagine how could painful and how much it will cost to stop a supply chain of a factory or something like this. It is a relative, a marginal cost compared with the benefits that you gain operating in a daily basis. So you need businesses like Viafin, which keeps your business running, okay? And this is so important and will be the core of the thesis, the recurrence of their revenues and the critical service that they give to their clients. Well, moving forward, we have here how Viafin service has grown on average of 20% per year, approximately, in a compound interest, okay? It did it between the 2018, when it started listing in the Nasdaq of Helsinki, and 2024. And this growth came with between a mix-up of organic growth and inorganic growth, of course, because they did a lot of acquisitions, as we will see below. Here we have the chart. It's quite impressive. And as commented, the clients are blue chip companies in Finland. We have here the portfolio and the diversification in detail. And it's true that this kind of businesses, these small businesses, can have some troubles if some of the main clients, like the number 1, 2, or 3, stops the operativity or choose other company to provide the services. In relation to the megatrends of the sector, we can see here like 4 or 5 main reasons why this sector will grow over the time. The first one will be the energy transition. And why? This is because nowadays there are a huge demand of clean and green energies like biogas, hydrogen, wind, and the clients of Viafin are exposed to these industries. So Viafin will take profit of it as well. About the outsourcing issue, it's because normally the companies tend to outsource this task to Viafin or companies like this. They tend to work with companies which has a lot of expertise, because maintenance requires a lot of specialization. So the clients of Viafin tend to work with them because of this, because Viafin has demonstrated over the time that they have an expertise in this field, and in order not to have any problems, normally companies tend to work with them. About digitalization is because nowadays there are a lot of information, and the clients needs to monitorize the data, and Viafin works on it as well. Safety, regulation, and ESG, again, a lot of compliance, a lot of regulations, a lot of certifications that Viafin has and works under. And again, what matters because they create like a entry barrier. Okay, they create an entry barrier for new players, and Viafin has been a lot of years here and have all the certifications, and again, it works under these policies very well. On the other hand, about the key financial or big numbers, what we have here is, again, to remark the structure of the business. It is structurally asset light. What does it mean? What means structurally asset light? It means that the company don't need too much money to operate. The company doesn't need too much money in terms of capital expenditures. Okay, so what we have here is a company which generates a lot of cash flow. What they do with this cash flow? Well, they do mainly 3 things. The first one is that they reinvest in their own business. How? They acquire a lot of companies. As commented and as we will see below, they have acquired a lot of companies through the time, and these have add a lot of inorganic growth into the equation. Okay. Secondly, they have a huge dividend policy. They give dividend, and the dividend yield is around 3%. So they share and give a huge dividend. And finally, what they do with the money is repurchasing their own shares. Okay, this is so important because they have a program to repurchase their own shares. And what it entails, as investors, you probably know, is that you have the benefit and you have the shares, and you remove the denominator, the number of shares, the benefit, the EPS, earnings per share, explode. Okay, and even the fact that they do these three things, as I said, they still have a net cash position, so they still have money to do it in a virulently way, in a superior level. Okay, but they don't do it because I suppose that they are very conservative. But if in case if they wanted to do it, they are capable. Okay, to give a huge dividend, for instance. And how is it possible? How is that? Well, we have here the acquisitions they made. For me, at least, the most important ones were the last ones, because they doubled the personnel. They increased to 100 people, and also they expand their activities across the country. And finally, we have the company valuation. Honestly, this is the main reason why I'm doing this video, because it is also the hardest part to explain. Okay, if you want to write it, it's hard, and this is the specific area I wanted to overextend myself and explain it. In this case, we apply three different valuation methods, which are the discount cash flow model, the multiple model, and also EBITDA multiple exit with a sensitive analysis with the discounted cash flow and this projected EBITDA. Okay, so we are going to do the Excel, and please bear in mind that this is not an investment recommendation, and you should not take it in any way as a recommendation. Okay, this is a personal view. This is for educational purpose, and again, all this information should not be considered for investment recommendation. All the information that we provide and I say is for an educational purpose. Okay, we have the Excel here. It's quite basic. Okay, the gaps that are painted in gray are the information I wrote from the official data of the company, from the official documents, and the other part are fulfilled by formulas. Okay, this will be the income statement, this one the cash flow, and this one the balance sheet. As you can see here, I have all the metrics, ROE, ROIC, etc. And this one will be the neutral scenario, the basic scenario, where I projected a 7% of revenue growth, 7% of margin EBIT, and what it gave me, based on the current price of the stock, and again with all the information I put. This is the net cash position I talked before. They have this money in the balance. We apply different multiples which are based on the average of the industry, and we can see different scenarios. This is the dividend yield. Okay, and what we can do here, well, as you can see, within this price and within this revenue growth and this EBIT margin, that is quite important, the return of the company that we have now is like 50% in 5 years. Okay, all of this takes into account the dividend. Okay, it's added to the formula. So with these multiples, what we have here are these returns. What we can do here, different scenarios. If we see that the company is not doing well and the revenues decrease to 5% over the time, and even the EBIT margin decreases like 6.5, we also will need to apply a fewer and low multiples. Okay, because the company is not growing at the average that they promise, and they are struggling. So let's say that from 15 they went to 13. We will low like 2 points each, okay? And as you can see, the returns change completely. This is more humble returns, okay? And we can see also a different scenario which the company, this will be the worst scenario, okay? I don't see Viafin growing less than 3% organically or something like this, and the margins less than this. Again, it's not impressive, but well, at least you will not lose money. But what would it happen if they do well, if the performance is quite good, more good than we expected? Okay, we grow at 10%, which is the average the company tends to project. The margin also grows a little bit over the time, like 7.5, 8%, let's say. And the multiples, again, if the company is doing better than we expected, why not put a slightly higher multiples? And what we have here, as you can see, again, taking into account the dividend, are these returns, okay, based on the current data. On the other hand, we have here the discount cash flow model. As you probably know, there are different variables like the terminal growth rate, the initial growth rate you can put and change, and also the different variables that affect the WACC. Okay, as you can see, I put 1% for a specific size premium, company specific premium, 2% of size premium, market return, the treasury bond yield. I took the 20-year treasury bond yield. Some people take the 10-year bond yield, okay, and the beta. So this is the price that the discount gave me, okay. And it is based on the last cash flow for me, and under my maths, this is the last EPS, earnings per share, that the company has, okay. Again, we can play with different scenarios. If we apply only 1% of terminal growth, you can see how the price decreases, or even on the contrary, if we apply a huge initial growth rate for the EPS, like 5%, we can see how it grows. And it's a thing that you have to consider, that the discount cash flow is very sensible, and if you touch a bit, if you touch one variable, the price that the company has, the fair value of the company, the objective price that you are calculating, will vary a lot. And finally, what we have here is the third method, okay. This is the projected EBITDA to the next five years, which is this. I apply a multiple, in this case 8. I calculate the terminal value, I add the next 5 years of cash flow, and I bring this terminal value to the present, okay. And I divide it by the outstanding shares. So what we have here is the net equity share. As you can see, it's very similar from the discounting valuation method, and this is why I like to do these three valuation methods, because as you can see, the multiples gives us a different valuation. The discount gives us this objective price for the share, for the company. And here we have also another one. It's true that they are quite similar, but I like to do this because here I can project the different scenarios depending on the different perpetual growth for the discount cash flow and the different WACCs, okay. And you have here the table, the different range of prices that the company are into, and also the EBITDA, the projected EBITDA, and bringing to the present could have also with different multiples if we apply it in this formula, and the different WACCs also that we apply to this value, so we can bring this value to the present. So as a conclusion, and briefly, what we have here is a well-run business with no debt, with a healthy balance sheet, with an stable and recurring revenues, and position it in a stable and niche sector. So that will be all. I hope you have enjoyed. I hope you have learned something, and see you in the next video. May the investment be with you.